All right, trading update time. I haven't done a trading update for, I don't know, a couple of months. So we are now just beginning September. So we've got the last September, October, November, December, last 4 months. It's a good time just to see how we're looking. Obviously, if the market does crazy things, we can't extrapolate out, but let's crunch some numbers and see where we're at. All right, so if you've seen any of my previous trading reviews, you know that this one is my daily realized P&L. So it's not my NAV, it's not my net asset value, it's my realized trading numbers. So a couple of negative days here, and then, just pretty. So what I'm looking for is there any reason from the recent, these are days when I'll probably start this again when I get to a certain number of day count when I can't visualize it, start this all over again. But what I'm looking for is this cluster here was that big draw down in April when the Trump tariffs came out. And then since then, it's been, if you take this clump and go back through these clumps, it almost looks like I've got a little bit better with my process. I don't know if that's just me looking, but these appear, I don't know what you think, like I'm a little bit better in my consistency compared to back here. Anyway, just something that so that's it. So what I was going to say was, is there any reason to believe that what you're doing now, is it degrading, improving, or the same? I would say that it's not, I wouldn't say this is degrading. I wouldn't say it's getting markedly better. I would say it looks like I've got maybe more consistent, or maybe the market is giving me more consistency since that big drawdown on Liberation Day when Trump tried to send everything to zero. So, it might just be a result of that. But that's kind of something I update manually each day, is my realized P&L. So that then comes to the NAV, which is a very different type of graph. Here's that April Liberation Day. And then since then, we've been back climbing. So that's something I record. Then these are, one of my brokers is Interactive Brokers, and a large part of my portfolio that I'm managing is in there. And so year to date, I have retracted my, in this block here that I've like blocked out, is my account number and and the number that's in the account, which I don't want to share. But so what I am sharing is that this is performance versus the S&P 500. So my rate of return year to date is 19.63. Now, you might be like, oh, that's rubbish. Yeah, it may well be. But the S&P, my index, is, well, it says it's around 10, and I'm at almost 20. So I'm always happy if I'm beating the S&P, which is not easy to do. I think the hedge funds index of the hedge fund returns is also around 10. It was beating the S&P by 0.4%, so but chances are it's somewhere around here. Anyway, again, I think I've got a little bit better, especially here. I got quite a degree of separation in this section. Here I was very much tracking, but it looks like I was just compounding slightly better than the S&P. Anyway, what I then look at is, let's compare to the Qs. Normally the Qs, obviously in a down market, they go down usually more, but in an up market, they go up more. So my degree of separation, obviously it's the same return, is slightly less because it looks like they're at around 12% on the year. It's funny, just at the end of last week, there was kind of a pop in performance. So my degree of separation was slightly greater, but we both popped up in these last few days. Anyway, it's just a benchmark. It's not the end of the day, but it's worth just comparing, because obviously if you just buy S&P or just buy the Qs, it costs you nothing, whereas I'm slogging my guts out for all of that difference, which can be demoralizing. The next one gives me slightly more hope. This is the Russell or the IWM or the RUT, depending on what you like to call it. This is where I get a much better degree of separation. And if you actually looked at the stocks within this account, they're much more of the RUT IWM market cap size. So on that basis, this gives me much more confidence to continue with what I'm doing, because it's clear that I'm, well, not so much here, had a major catch up, but I'm doing okay is my point when I compare myself to the benchmarks. And, that's all we can do. So in Interactive Brokers, there is, the main point of this video is I haven't looked at this for a while. So you go into Interactive Brokers, and in Portfolio Analyst, you can go into something called like risk measures, is what they've called it. And there's the date. So it's to the 5th of September, starting at the beginning of the year. So it's year to date. Now, these are the numbers for the SPY, and these are the numbers for my account. Again, I've just retracted my account number. So if you're getting into trading, if you're interested in this type of stuff, here's what I look at when I ponder these. So just to give you some background, when you're trading a lot of options, your risk numbers can look quite bad, because often you're leveraged and the risk you're taking to the returns are a bit squiffy. In this account, I've got quite a bit more stock. So the numbers actually, weirdly, I hadn't looked kind of for a long time, but they're actually, well, let's have a look. So your VAMI is basically how much, if you put £1,000 in, how much you'd be at now. Your max drawdown is, as it says on the tin, and my pleasing bit is that the SPY max drawdown in this period was 7.58%. This is on a monthly basis, by the way. And I will, on my next slide, I've got slightly better granularity on here. This is a monthly risk measure report, hence why it says here 2 months, which isn't granular at all. But these numbers are generally calculated. Like if you were to ask a hedge fund, what is your Sharpe ratio? It would be calculated on the monthly Sharpe ratio. So I'm at 1.78. Now, let me just, I'm going to ask Rock, is 1.78 Sharpe ratio good, bad, or what? A Sharpe ratio of 1.78 is generally considered good to very good, depending on the context, such as the asset class, market conditions, and investment strategy. If you're now running this same report, here's some info for you. So less than 1 is considered subpar or poor. Returns may not justify the risk taken. So that's a major factor for you if you've got that. Between 1 and 2, it says it's good. Indicates solid risk-adjusted returns, typical for well-managed portfolios or funds in stable markets. Okay, great. I'm right in there, 1.78. 2 to 3, very good. Reflects strong performance with efficient risk management, often seen in top-tier funds. Okay, I am not achieving very good. 3 is exceptional, rare, and typically achieved by highly skilled managers or in specific market conditions. Why 1.78 is good? Suggests the investment generates 1.78 units of excess return above the risk-free rate per unit of risk, the standard deviation. This is above average for most portfolios, especially for equities or diversified funds. For comparison, this S&P has a long-term Sharpe ratio of 0.5 to 1. Depending on the time period and the risk-free rate used, 1.78 ratio outperforms this benchmark, indicating strong risk-adjusted returns. Okay, so that's great. So a 1.78 ratio is excellent for volatile assets like stocks or crypto, but less impressive for low-risk assets like bonds, where higher ratios are easier to achieve. Okay, because they have no standard deviation. Okay, fine. What else did it say? Yeah, this will vary. So anyway, it's an important number, that, because it gives me confidence that what I'm doing, I'm kind of on the right track. Sortino ratio, let's just ask about that. A Sortino ratio of 3.37, good or bad? I'm asking Grok, by the way. I do like the Grok. A Sortino ratio of 3.37 is excellent. Yes! And it indicates very strong risk-adjusted performance, particularly when focusing on downside risks. So the Sortino ratio, it calculates excess return, portfolio return minus risk-free rate, per unit of downside deviation. Ooh, these are mouthfuls, aren't they? And that's the volatility of negative returns. Unlike the Sharpe ratio, it only considers harmful volatility, making it a preferred metric for risk-averse investors. Okay, so less than 1 is poor, 1 to 2 is good, 2 to 3 is very good. Ooh, I'm slightly proud right now. Greater than 3 is exceptional. Yes! Reflects outstanding risk-adjusted returns with minimal downside volatility, rare for most investments. Oh, I didn't even know. I didn't even know this. I'm literally just finding this out. Ah, cool. A Sortino ratio of 3.37 means the investment generates 3.37 units of excess return for each unit of downside. So if you've got an interactive broker's account, go on there now, go to year to date, go monthly, go to portfolio analyst, click on risk measures and have a look at what your numbers are. Stick them in the comments because I want to know how everyone else is doing. Anyway, this is significantly above average, indicating the portfolio asset delivers high returns while experiencing very low losses. The SPY, for example, Sortino ratio below 2 over long periods. A 3.37 ratio is competitive even among top-tier hedge funds or specialized strategies. Blah, 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 blah. So here we go. Comparison to Sharpe ratio, because I guess they're relative. You mentioned a Sharpe ratio of 1.78, yeah, which is a good but lower than the Sortino ratio of 3.37. The discrepancy suggests the investment has significant upside volatility, positive returns, that the Sharpe ratio penalizes, but the Sortino ratio ignores, highlighting excellent downside risk management. Well, that's cool. That's really cool. All right, here we go. Standard deviation 3.37, downside deviation 1.76, mean return 2.07, positive periods, negative periods, blah, blah, blah. Okay, correlation. Now, this bit's the important bit to me. Correlated to the SPY, I'm 0.83. So what that means is if the SPY moves 1, I move 0.83. That's how I read that. Let me just check if I'm accurate. Correlation measures the strength and direction of the linear relationship between an investment's return and the SPY's returns. Ranges from -1 to 1. Correlation of 0 indicates no linear relationship. Okay, so it's just kind of how you're tracking. The beta measures an investment's sensitivity to movement in the SPY. Beta of 1 means the investment moves in line with SPY. Yeah, okay, know all that. And then the alpha measures the excess return of an investment relative to the return predicted by its beta, based on SPY's performance. Positive alpha indicates outperformance, negative alpha indicates underperformance. So for me, I believe 0.12 is a 12% excess return that my strategy generates. Okay, cool. Right, so at the moment, looking at all these, I have no major concerns. I kind of want to outperform a little bit more, but I don't know how to do that. The last bit is, this is the same report, but using a daily calculation. And the bit that I'd like here is, so it goes into more granularity on that drawdown. So 18.76 was the Liberation Day drawdown of the SPY. My account went down 15.43%. So I'm markedly better in the drawdown. And the recovery was even more pleasing. So 57 days for the SPY to get back to all-time highs. It took me 24. I'm actually really chuffed about that. So yeah, I mean, I'm always working on my strategy, but that kind of, I think to me it suggests what I've been doing has been working. So where to finish? I don't know. I'm still doing, if you've followed previous videos, I'm still actively trading a portfolio of stocks. I get a position, I trade around it, actively trade, maybe 150 trades a day, try and generate this realized gains. I'm trying to obviously beat the SPY. These numbers are reassuring. So it really is a case of continuing and doubling down on what I seem to be doing well on. So I work on my stock selection, work on getting rid of some stocks that aren't performing, bringing in new stocks, being quite active. But really continuing this, if this was the end of the year and we were looking at these numbers, I would deem it a successful year. I'd love to know, because I know for many that this, is rubbish. My Sharpe is rubbish, my Sortino is rubbish. For many, this is, isn't so good. But for me, this is pleasing, and I'd love to know how you're doing. If you're trying, if you're looking at it, your returns, if you're trading, if you're thinking about trading, because I do enjoy what I do. Right, I think that's it. I think that's everything. I'm pondering a get-together in KL for any traders out there that watch this channel. Let me know if you're interested. I'd love to shoot the breeze, talk trading, hear about what others are doing, and maybe we can learn from one another. All right, that's it.